Hey guys, Jim here. Just want to say a quick happy Father's Day to everyone. And today I'm going to bring you kind of a unique type of video. I'm going to talk about when you have positions that get deep in the money, how I handle them, how I'm a little bit different than a lot of other people since I'm a long term income investor. I like to keep a lot of the stock. Sometimes that can be a mistake. It was a mistake with companies like Big Lots and Lumen. So I'm going to talk about some of the names recently that I've decided to still keep. For instance, CVS, Path, and even Shopify. I'm going to talk about how I calculate, what my profit or loss might be, and how I plan to kind of deal with these particular trades going forward. So I think you're going to enjoy what I have for you today. So please stay tuned. I'm just going to kind of go through this briefly and then actually share with you, again, another spreadsheet that I use to calculate profits and losses. So, being an income investor, I really like to hold the companies. I like to hold them long term, like to see the appreciation. Some of my biggest mistakes I like to talk about, like Lumen and Big Lots, but the ones I don't talk enough about, especially to my subscribers, now I do to members, I go into a bit more detail, or the ones that I've missed great opportunities. I talk about how I missed Apple when Microsoft provided them a bunch of money to save them. I looked at actually making that trade. And I missed a lot of opportunities back in 22. I rolled out of some potentially great trades that I could have owned, like Apple at a really good price. I believe Tesla at a really good price. Maybe even, I think I did some trades on Google that I rolled out of trouble. So that's something a lot of people don't realize. You can literally miss some great opportunities. There's no single stock that continually goes up and up and up. Now, it seems that way with NVIDIA, but NVIDIA even had a rough spot earlier this year. I believe in April, if you look at their highest point in April and their lowest point, I believe it was a drop around 11, 12, maybe even 13%. And you're going to see that with a lot of stocks. Now, some you may see it, a bigger drop than what happened with NVIDIA. Like Path, I think, dropped 30%. I believe CVS also dropped like 20 or 30%. And same thing with Shopify. I think Shopify might have been closer to 20%. But again, is it an opportunity? And are you, by closing that trade or rolling to a different one, are you missing a wonderful opportunity to own a great company at a cheap price? So, for me, I found patience is a virtue. A lot of times, if something has dropped and you're assigned the shares, you have time to make a decision. You don't have to make a quick decision to close the position with a loss. I believe a lot of people who get into options trading, you end up looking at the stock price too much. You almost become glued to it, and it forces you to look at it quite a bit. I've been trading stocks for many, many years. I've been through all the big crashes since 87. And I, through thick or thin, I pretty much stayed in the market. But a lot of times I wasn't looking at it. I was going on and doing other things. I might look at my accounts once or twice a week, but selling options, you're definitely looking at your positions and how profitable they are. And for me, again, being a long-term investor and an income investor, because I also consider if I make a purchase of a stock, what kind of income can it bring me? Now, if it's a growth company and it doesn't have dividends, then it's more, can it appreciate in such a way that potentially I could trim it and bring in some cash that way. And I've done that with a number. I've actually done that with NVIDIA, which was probably a mistake, but I trimmed a share or two here and there. Which I needed the cash at the time. Now, time will tell if NVIDIA keeps going up. I think it hit 131. If it goes up to 140, 150, 160, then, that definitely was a mistake. But if it suddenly also drops back, I like to compare NVIDIA with Cisco back around 2000 or 99. Cisco shot through the roof. It stayed, it hit really amazing heights, and then everything seemed to kind of turn around. It still does really well. It really has, good dividends, and it's a good steady company, but not a growth player. Now, NVIDIA still has good numbers, so I'm not really beating them down. But to me, I just want people to slow down, try to eliminate the emotion from the game, and take your time, try to make an educated decision as to what you want to do with the trade. Don't just get emotional and take a big loss. Because that's what I've seen a lot of people make big mistakes over the years. They'll get out of the market or they'll get out of the stock, and then they won't get back in a timely manner. So that's what I want to help people to avoid. And also remember why you made the trade. Why did you make the trade to begin with? Did you like the company? I typically trade in companies I want to own. So I go back, I look, having a membership and sharing the information on the front end, and I keep improving upon that. I'm even with my posts that I make to my membership about my trades, I'm going to go into even more detail. I'm going to start talking a little bit more about the potential income of a trade. Like, if it's a dividend payer, can I double the dividends? What would the dividends and the covered call income look like? Because a lot of times that's a key criteria for me, because I'm not just looking for premium, I'm also looking for really good dividends. So that's a key important thing to keep in mind. And if something's changed, again, it's easier said than done, but if a stock drops like Path or CVS 20-30%, of course your inclination will be, well, I don't want to own this anymore. But dig deeper and remember that, you go back to any particular, you look at a year for any stock, they're going to have times during that year that they dove. And then you're also going to have issues where management makes mistakes. I saw it with Square. I saw it with Shopify. I've seen it with Path. They recently got rid of their CEO. Now, I'm not blaming everything on him, but they may have, lost sight of their ultimate goal and maybe changed direction, and now they're, redirecting. So that's kind of important to remember. That way it keeps you more grounded, because nothing serious might have changed with that company. Well, maybe they lowered their guidance, but they're still doing well. So just keep that in mind when you're looking at it. And then I always like to talk about buying protection. So if you're doing a cash secured put, purchase the outer put for protection. So if give you, for instance, if you're selling a put on a stock that's 50 and you buy a put at 45, that protection can also help you lower your cost basis. So if the stock drops below, what you sold the put for, and it even goes down below your protection, that protection will go up in value. And you'll see in the next part of the video, when that happens, you can actually pick up a stock even cheaper. Again, something to keep in mind. And then having that put protection also gives you more choices, especially, if you have multiple contracts. You don't necessarily, you could, do different things based, say you have 4 contracts, well, maybe you do one thing with 2 and something else with 2 others. And then if you have the put protection, then you can even make more choices. And just a few, or you could close for a loss if you're just in selling options just to make income and you don't care about owning any of the stock, you're just kind of running it as a cash account, then you can literally close for a loss. You could roll for a better position by possibly widening the spread, meaning you're not quite ready to make the decision. A lot of times I found if I widen the spread, I can bring that short down. So say, same example, I sell the 50 and buy the 45. If I widen it and when I roll it, I buy the 40, not the 45, and it gives me a bit more cash that I can move, the 50 to maybe 49 or 48 and, adjust the trade lower and lower, try to pick, especially for a put, go with a lower put. And the reverse is true with calls. Maybe you want to up the price a bit, $1 or $2, or maybe significantly more. It gives you some choices you can make by buying that protection. Also, full assignment. If the sale of the put protection, meaning instead of taking full assignment, you could sell those puts because you're going to own those shares. And so that put is worth a lot and you can bring in quite a bit of cash. Then another choice is if you have full assignment, meaning if it's 2 contracts, you own the 200 shares, you could still use that put protection to put it to someone else. Now, a lot of people might say, well, if you close, for a loss, it's going to be about the same amount. Well, I've done some calculations and I found it could be different by a significant amount of money at different times. So a lot of times I'll plug it into a worksheet just to see what it looks like. Then you can also do full assignment and partial sale, and sale of the put protection. So with CVS, I had it in the wrong account, was probably my biggest mistake, or I would have kept 200 shares. But I didn't have enough cash in that account. So I sold 100 shares and I kept 100 shares. I sold the puts and I did take a loss, but not as big a loss as I possibly would have taken. So I wanted to share that. I'm going to actually jump into another part of the video where I'm going to share with you a couple of these worksheets for CVS, Path, and Shopify, and talk about my reasoning behind it a little bit deeper. And as always, please subscribe, hit that like button. If you want to look at my memberships, details will be in the description. I am changing them. I'm probably going to increase prices here before too long, especially with my coaching. I initially did that just to bring people in, and I'm not going to do anything radical, but it's too good a deal almost. Now, I did change it from weekly to bi-weekly, and I may change it to one a month, and I might have to increase the price. I haven't decided. I'm also going to look at potentially doing a yearly type scenario where you could pay monthly or yearly. I haven't quite decided about that, but I encourage you to take a look again because I'm going to make some changes here before too long. So that being said, let's jump into the next part of the video. Okay, here's the worksheet that I typically use to look at how I'm doing with a particular stock, profit loss wise, especially with assignment when it's early assigned. So for Path, this is the worksheet for Path. I had 400 shares assigned to me at $21. So it was 8,400. I did sell the puts. I made an additional 1,209, which worked out quite well. So you can see the beauty of buying the protection. It does lower your cost. And then I had the opening trade of 418.55 is what I brought in. And then when I rolled, I also brought in 377.75. So quite a bit of good premium related to selling puts at that time. Now, then the total cost was $63.94.42 per share. That's about $16 per share. Now, if I look at a profit and loss calculation, so I brought in 8,400. These are some of the same calculations, just reversed. I brought in 1,209. I brought in 418. I brought in 377.75. The value currently, and this is as of Friday, was 1154. So it did drop. I think it got back up to like 12 and a half. Then it recently, last couple of days, it dropped a bit again. And I'm not sure this is an all-time low, but it's really close to an all-time low. So the value of 400 shares is 46.16. So my total loss for it is 17.78. And that's like per share, that's like 4.45. So if they recover in price above the 16, I've probably broken even. And then I'm also going to start selling covered calls in it, and I'm expecting the covered call premium to be really good. Now, why did I decide to keep Path? I did have a lot of members that decided not to, and they lost hope in Path. I like their product. I've looked at their product. I've liked what they've done. They have relationships with Microsoft, with different companies. So I just have some faith in the product. I actually downloaded it, played around with it. So I'm taking a chance here. Could it half again? Could it get down to $6? Well, it could. It could turn into another Lumen. But this is a risk I'm willing to take. And again, at $21 a share, I'm only putting in like after you take out the money I spent, I only spent $63.94. So it is still a lot of money, but it's a small percentage of that particular account, my Fidelity IRA. So I'm betting within 6 months to a year, it'll be back trading around $18 or $20. And then at that point, I'm back profitable again. Then I have 400 shares and I can sell covered calls regularly on it and do fairly well. Also, it could be a takeover target. I noticed there was some comments related to that maybe CRM might buy it because it might tie in well with some of the stuff that they want to do. So it could potentially be a takeover target. And they're not a small company. I mean, I think they're making, it might be like 1.5 billion to 1.8 billion or something. So I don't know. It'll be interesting to follow and see what happens. And I'd be curious, for some of the people who did decide to get out and took a loss, share a comment. Let me know why you decided. I know some people did mention some things, but a lot of times it's real high level, like, oh, this is just a terrible stock, or, a terrible company or something along those lines. I like to dig deeper. I'd like to know a little bit more about the company and play with the product. And again, since this is in an area that I like, I made that decision. But again, it's a risky decision. They could end up halving from where they are now, meaning instead of being 12 or 11.50, that could be $6. I wouldn't surprise me either way. And before the drop, they were 18.38, so they were doing pretty well before the drop. So here you can see, this is how I calculate it. And that's where it gets really interesting in, my journal and keeping track of it. I could register this as a 1778 loss, but if they pop back up within a couple weeks, well, I've just registered a loss that isn't accurate because I'm basing it on the value of the stock at that time, which can radically change. So I'm still trying to figure out how best to journal it or to calculate it in my planning worksheets, and then, how I track it. If you have any thoughts, again, add a comment. I'd be curious to what you guys think. Now, for a different example, I also have CVS, but I'm not going to talk about CVS at this time. I will talk about Shopify just to give you a different example. So Shopify also had a big dive. And again, there was lots of conversations about, should we get out of it? Should we take a loss? I think they dropped not quite as much as Path and CVS, but I think they dropped like 15%. So they were assigned to me 65, 200 shares. So you'll notice when they're $21, I'll do 4. When they're $60, $70, $80, I only do 2. If it's over 100, 150, I might only do 1 contract, that is. Again, because I don't want it to be too big in my account, or too much of my account, if you get my drift, because it is a little bit risky. Some of these, just because of the nature, they all seem to be in the same sector or the industry. Now, all these companies, like I said, I work with Path. I love CVS. There's one right near me that I'm in probably twice a week. I play tennis, and I like to stop to get some Gatorade, and I run in there, but I use their clinics and other things, so I like them. And in Shopify, I also use Shopify related to my business. I did not sell the puts. They weren't worth enough. I think they might have been worth more initially, but then I waited. Again, I took my time to decide what I wanted to do. But the opening trade, I did bring in 345. It did recover. It had a really good day. Shopify did. So I sold some covered calls, brought in $532, which at this point puts my cost basis at around 12,122, which is like a 61 cost. And then the fact that it kept recovering, it's now currently, as of Friday, it was 67, 66. So of course, definitely above my cost basis of 61. So here's, originally when I did this, and that's what I was talking about, it's kind of hard to figure out how to journal this. So initially this was a loss, and not quite as big as Path, but a pretty big loss. So there's the 13,000. Again, I had no puts to sell. Original put I sold, I made 345 in premium. Then 532.64 in covered calls. Then the value of the 200 shares at 57 or 67.66 is 13,532. So the total gain or loss is 1409, or nearly $7 a share. Now I started this trade in early April. I believe it was April 10th. So I believe I've only had it for 67 days. So if you calculate it, where it stands currently, if I was to close it at 67.66 on Monday, I would bring in 1409 for 67 days. Here you can see DTE of 67 up here. which was almost like a 60% return. So if I had just literally taken the loss with this particular trade, I probably would have had a 30, maybe a $1,200 loss at the time. So sticking this out and the fact that it has such good covered call premium, it's going to work out well. I believe the covered call premium alone had like a 13% return. So some of the key notes, I probably should have sold the puts a little sooner. I think I always wanted to keep Shopify, but in the time period I looked at it, it did recover some, and then the puts weren't worth anything. So if I had been able to make my decision quicker, it might have worked out a little bit better. I lowered my outlook for the rest, or they lowered their outlook for the rest of the year. So they did meet or beat earnings, but then they lowered their expectations. They did miss for their GAAP earnings. Again, it's related to the compensation for these small companies. And I put Path and Shopify and Palantir and some of these same companies, Twilio, all in this kind of the same category. Going forward, I'm going to do fewer trades in these. Also, what is it? Square and then PayPal. I would also, and even eBay I'd put in this category. eBay does pay a pretty good dividend now. So to me, it's a little bit different. But they did lower their outlook. So that's partly why they got hammered. They, again, really good covered call premium. Currently has no dividend, but if they had a dividend, then that's something else I would consider. And if it's paying, like I believe eBay is paying like a 2.5 or 2% dividend, but it's simple to triple, or even definitely you could double, you could almost triple it. So in covered call premium, and then they're increasing their dividend significantly. So that's another criteria that's really important, because I'm looking for investments that generate a fair amount of dividend income and grow those income, and I can sell covered calls and do fairly well with them. So that's what I wanted to share with you guys. Again, any comments? What do you think? Do you agree? Do you disagree? Do you just trade options for income and don't really care about owning any stock? I'd love to hear from you. And as always, thank you for joining me, and I look forward to seeing you next time.